The night the first reports surfaced, global markets were already fragile. Traders were watching oil charts more closely than stock tickers, sensing that something was about to break. Then the headlines hit like a shockwave. Unconfirmed reports of U.S. military strikes targeting strategic Venezuelan assets. At first it sounded like another rumor in a world saturated with breaking news. But within minutes, oil futures spiked. Shipping stocks froze and currencies across emerging markets began to slide. This wasn't just another regional conflict. This was a potential trigger for a global financial chain reaction. You understand why U.S. strikes on Venezuela could destroy global markets forever. We need to understand what Venezuela really represents in the modern economic system. On the surface, it's a country many investors wrote off years ago, crippled by sanctions, hyperinflation, and political chaos. But beneath that surface lies one of the most underestimated pressure points in the global economy. Venezuela holds the largest proven oil reserves on Earth. Not Saudi Arabia. Not Russia. Venezuela. And in a world already starved for stable energy supplies, that fact alone turns any military action there into a global market nightmare. For years, Venezuela has existed in a strange limbo, sanctioned by the United States, partially isolated from Western markets, yet quietly connected to global energy flows through intermediaries, shadow shipping networks, and backdoor trade routes. Oil from Venezuela doesn't just disappear, finds its way into refineries in Asia, blends into global supply chains, and stabilizes prices in ways most people never see. If U.S. strikes were to disrupt that system, even temporarily, the shock wouldn't stay contained within Venezuela's borders. It would ripple outward, hitting energy markets first and hardest. Energy is not just another sector. It is the foundation of modern finance. Every factory, every shipping route, every data center, every military base depends on it. When energy prices spike unpredictably, markets don't just decline, they malfunction. Liquidity dries up. Risk models break. Correlations that traders rely on collapse overnight. And this is where Venezuela becomes uniquely dangerous. Any conflict involving Venezuelan oil immediately collides with existing tensions in the Middle East. The Russia-Ukraine war and fragile OPEC agreements. The system has no shock absorbers left. Imagine the immediate aftermath of confirmed U.S. strikes. Oil prices wouldn't rise gradually, they would gap higher. Insurance premiums for tankers in the Caribbean would explode. Shipping firms would reroute vessels, delaying deliveries worldwide. Refineries designed specifically for heavy Venezuelan crude would struggle to find substitutes, forcing shutdowns or expensive retrofits. This isn't theoretical. We've seen smaller disruptions cause massive chaos. Venezuela would be different because the market already assumes its oil is mostly offline. When something presumed dead suddenly becomes critically important and then gets hit, that's when panic begins. But oil is only the first domino. The real danger lies in how financial markets are structured today. Modern markets are built on leverage, derivatives, and assumptions of stability. Hedge funds don't just trade oil, they trade expectations about oil. Pension funds don't just hold stocks. They hold exposure to global growth models that assume energy flows will remain uninterrupted. When those assumptions break, forced selling begins, because investors want to sell, but because they have no choice. Margin calls don't care about geopolitics. They demand cash immediately. Now layer in Venezuela's geopolitical position. Any U.S. strike would not happen in isolation. Russia and China both have strategic interests there. China has lent Venezuela tens of billions of dollars, much of it backed by future oil shipments. Russia has military advisors, energy investments, and political leverage in the region. A U.S. attack would instantly raise fears of proxy escalation, not necessarily war, but retaliation through cyber attacks, trade disruptions, or financial warfare. Markets fear uncertainty more than bad news, and this scenario delivers unlimited uncertainty. Currencies would be next to fall. Emerging markets already fragile would see capital flee overnight. Investors would rush into dollars, but even the dollar wouldn't be safe for long. Why? Because a prolonged conflict would increase U.S. deficits, disrupt global trade, and force central banks into impossible decisions. Raise rates to fight inflation caused by energy shocks, or cut rates to prevent a market crash. Either choice breaks something. This is how systemic crises are born, not from one event, but from policymakers being trapped with no good options. Stock markets, meanwhile, would enter a new phase, not just volatility but dysfunction. Circuit breakers might halt trading, but they can't restore confidence. Tech stocks would fall as energy costs hit data infrastructure. Manufacturing stocks would collapse as supply chains seize up. Banks would face rising default risks as companies struggle with higher costs and falling demand. And unlike previous crashes, there would be no clear buy-the-dip moment. Investors wouldn't know where the bottom is because the conflict's timeline would be unknowable. What makes this scenario especially dangerous is timing. The global economy is already stretched thin. Debt levels are historic, consumer savings are declining. Central banks have less credibility than they did a decade ago. In this environment, a shock the size of a Venezuela conflict could push markets past a point of recovery. Not a recession. It's not a correction. A structural break where old models stop working permanently. And perhaps most unsettling of all is how quietly this could begin. No formal declaration of war. No dramatic speeches. Just a few strikes, a few headlines, a sudden spike in oil. Then, slowly at first, the realization spreads. This isn't going away. This is different. By the time the public understands what's happening, markets would already be deep into freefall. This is why Venezuela matters. It's not because it's powerful on its own, but because it sits at the intersection of energy scarcity, geopolitical rivalry, and financial fragility. When those forces collide, history shows us the outcome is never contained. It spills over, it escalates, and it reshapes the world. When the news of U.S. strikes in Venezuela becomes undeniable, the reaction from global financial institutions would be instantaneous and catastrophic. While most people think of market crashes as slow processes, the modern financial system reacts in milliseconds. High-frequency trading algorithms would detect spikes in oil futures, energy ETFs, and derivatives tied to emerging markets. Within seconds, billions of dollars could be automatically liquidated, long before any human has the chance to react. These algorithms don't understand politics. They only respond to price movements. That automatic panic alone could trigger cascading sell-offs across every major exchange. Banks would be next in line. Major financial institutions hold enormous exposure to Venezuelan energy through loans, bonds, and indirect derivatives. Suddenly their balance sheets would be under immediate pressure. Institutions like these operate on assumptions of liquidity and predictable risk. When those assumptions fail, panic becomes self-reinforcing. Banks would start restricting lending, freezing lines of credit, and demanding margin calls. Companies that rely on these funds for daily operations, from importing raw materials to paying employees, would instantly face existential threats. It's not an exaggeration. This is how a regional crisis morphs into a global financial meltdown. Hedge funds and private equity firms would accelerate the panic. These institutions thrive on leverage and speculation. Venezuelan oil markets are disrupted. Many hedge funds that have bet on stable energy prices would face immediate losses. To cover margin calls, they would be forced to liquidate assets across unrelated sectors: technology, agriculture, manufacturing, creating a domino effect. This isn't just a theoretical scenario. Historical examples like the 2008 financial crisis demonstrate exactly how leveraged positions in one sector can collapse global markets and ours. In 2026, leverage is far higher, and the complexity of derivatives far greater. Emerging markets would suffer first and hardest. Nations in Latin America, Africa, and Southeast Asia are already highly sensitive to energy shocks. Many of these economies rely on imported oil or raw materials priced in US dollars. A sudden spike in oil caused by disruption in Venezuelan exports would devastate these nations' currencies. Investors, sensing instability, would rapidly withdraw capital, creating severe liquidity crises. Governments would struggle to defend their currencies, and debt crises would erupt almost simultaneously in multiple countries. In other words, what starts in Venezuela quickly becomes a multi-continent economic emergency. Meanwhile, energy companies worldwide would scramble to adapt. Refineries configured for Venezuelan heavy crude would face shutdowns or require expensive reconfigurations. Shipping companies transporting oil from the Caribbean would face skyrocketing insurance costs due to perceived military risks. Even countries not directly connected to Venezuelan oil would feel the pinch as global energy supply chains seize up. Fuel shortages, industrial slowdowns, and transportation disruptions would amplify market panic, turning a financial crisis into a broader economic one almost overnight. Now, commodity markets beyond oil would not remain untouched. Venezuela produces significant amounts of nickel, bauxite, and other minerals critical for industries ranging from aerospace to electric vehicles. Any disruption in Venezuelan exports would send these markets into volatility, further destabilizing stock indices globally. Investors would be forced to reallocate capital. But with liquidity frozen in some markets, those reallocations would worsen price swings. The result? Global feedback loop. Commodity spikes fuel market panic destabilizes commodities, and the cycle continues. Credit markets would experience unprecedented stress. Corporations and governments rely heavily on short-term borrowing to fund operations and debt obligations. With oil disruption and financial institutions under duress, interest rates would spike in secondary markets, making it nearly impossible for companies to secure financing. Even the most stable multinational corporations could face cash crunches. Suddenly, the threat of bankruptcies across multiple sectors is no longer hypothetical and becomes a looming reality. Rating agencies, in their attempts to respond, would downgrade bonds en masse, further exacerbating panic. The technology sector would face indirect but severe consequences. Modern tech relies on constant energy and uninterrupted supply chains. Semiconductor production, data centers, cloud services, all are energy-intensive and vulnerable to disruptions. Rising energy costs would squeeze margins, delay projects, and force layoffs. Investors already jittery from financial instability would pull back from tech stocks, intensifying market declines. This interconnection highlights a chilling truth. In today's globalized economy, strike in Venezuela could cascade into industries far removed from energy, affecting everyday life worldwide. Geopolitical reactions would accelerate the crisis further. Russia and China, with strategic interests in Venezuela, could retaliate through financial, cyber, or trade channels. Even if retaliation is limited, market perceptions alone would trigger panic. Investors hate uncertainty, and uncertainty about global conflict is the ultimate market disruptor. Stock exchanges in Europe, Asia, and the Americas would see unprecedented volatility. With index swings that would dwarf anything in recent memory, automated trading, leveraged positions, and algorithmic hedging would magnify these swings into freefall. Insurance markets would collapse as well. Companies that insure shipping, infrastructure, or even corporate debt rely on predictable risk. The sudden spike in military and geopolitical risk would render many policies inadequate. Insurers would raise premiums astronomically, withdraw coverage in higher-risk areas, and demand collateral up front. This would ripple through trade, slowing imports and exports, and driving prices higher in almost every sector. For investors, the inability to predict or insure risk would compound fear, accelerating capital flight from vulnerable markets. Unlike traditional crises, where governments and central banks have days or weeks to respond, a Venezuela-triggered collapse could hit in hours. Traders, hedge funds, and banks operate in real time, and their automated systems would act before human intervention. Emergency meetings in central banks and finance ministries would come too late to prevent initial waves of panic. By the time coordinated responses are announced, market confidence would already be shattered. In essence, modern finance doesn't allow for slow-motion disasters. Everything happens at the speed of technology. This brings us to the human factor. Market participants are not just algorithms, they are driven by psychology. Fear spreads faster than facts. As news of strikes spreads and energy prices soar, institutional and retail investors alike would face a crisis of confidence. Panic selling would accelerate. Media coverage would amplify anxiety, creating a feedback loop between perception and reality. Even nations with strong fundamentals could see temporary collapses in their stock markets, purely because fear has become the dominant force. The final domino to consider is debt exposure. Global debt levels are at historic highs. Corporations, households, and governments are all carrying enormous obligations. A sudden spike in interest rates, currency devaluation, or energy costs could trigger cascading defaults. Credit default swaps would be triggered, amplifying losses across interconnected banks and hedge funds. What might start as a regional conflict becomes a global credit crisis. This is the point where markets don't just decline, they fundamentally fracture. In summary, the first 72 hours following U.S. strikes on Venezuela would be a perfect storm. Algorithms, leveraged positions, emerging market vulnerabilities, energy supply disruptions, geopolitical retaliation, and human psychology would converge to create a financial shock of unprecedented scale. Markets would not merely react, they would overreact, spiraling into a self-reinforcing collapse. Unlike past crises, there would be no safe havens, because every major market is connected through energy, trade, or finance. What begins in Venezuela could very quickly become a global catastrophe. As the first wave of market chaos unfolds after U.S. strikes in Venezuela, governments and central banks around the world would spring into action. But their interventions could paradoxically accelerate the collapse. Policymakers would face a brutal dilemma: act too slowly, and markets spiral uncontrollably. Act too aggressively, and they risk triggering panic in other sectors. In the first 24 hours, emergency meetings in New York, London, Frankfurt, Beijing, and Washington would dominate the global financial agenda. Yet even as officials scramble, the reality is stark. The modern financial system is far too interconnected to contain a shock of this magnitude. Central banks would likely attempt immediate measures to stabilize liquidity. Overnight lending rates would be cut, and emergency lines of credit extended to banks facing margin calls. The Federal Reserve might inject tens of billions into the system to prevent a collapse of major U.S. banks. The European Central Bank and the Bank of England would follow suit. But these moves come with their own risks. Injecting liquidity into a panic-driven market often amplifies volatility because it signals the severity of the crisis. Investors interpreting such moves as desperation could accelerate capital flight to safer, more tangible assets like gold, U.S. treasuries, or even cryptocurrencies, creating unintended distortions. Meanwhile, governments dependent on energy imports would scramble to secure alternative supplies. Countries in Europe, Asia, and Latin America would compete aggressively for oil from other sources, sending global prices even higher. Strategic reserves would be tapped, but these reserves are limited, and they cannot replace the volume of Venezuelan crude flowing into the market before the strikes. The result is a perfect storm: a simultaneous spike in demand, a reduction in supply, and uncertainty about when stability will return. Markets hate uncertainty. In this environment, panic spreads faster than facts, and even small rumors can trigger massive sell-offs. In parallel, hedge funds and institutional investors would reassess their exposure to emerging markets, energy, and commodities. Forced selling to cover losses in one sector could trigger cascading failures elsewhere. Companies with multinational operations, already under pressure from rising energy and shipping costs, would be forced to cut expenses rapidly. Layoffs, halted projects, and frozen investments would multiply the economic fallout. Even the strongest corporations could face solvency concerns if their supply chains or energy costs are disrupted for weeks. The interconnectivity of modern finance ensures that one crisis quickly metastasizes into another. Cybersecurity risks would compound the situation. As tensions rise between the U.S., Russia, and China over Venezuela, state-sponsored cyberacts could target financial institutions, energy infrastructure, or government networks. Even minor disruptions in trading platforms or payment systems would magnify investor fear and destabilize markets further. Modern finance relies on near-instantaneous transactions. Any interruption can snowball into a perception of systemic risk, which itself becomes a self-fulfilling prophecy. The combination of geopolitical tension, economic vulnerability, and technological dependence creates a perfect recipe for a global market meltdown. The human element cannot be overstated. While algorithms amplify market reactions, the decisions of CEOs, fund managers, and government officials can either stabilize or destabilize the situation. Panic in financial leadership spreads faster than any headline. Calls to liquidate assets, halt trading, or suspend contracts can create real-world shortages and liquidity crises. Even with coordinated international efforts, the perception of instability can outweigh any concrete interventions. Fear becomes contagious, and once markets lose confidence, recovery becomes extremely difficult. As days progress, the second wave of consequences emerges: systemic debt defaults. Global debt levels are at record highs, and a disruption in liquidity, combined with rising interest rates and commodity prices, could push both corporate and sovereign debt to breaking points. Countries reliant on foreign investment would see massive withdrawals, and governments might be forced to restructure obligations. This could trigger a domino effect. One nation's debt crisis prompts fears in others, creating global contagion. The sheer speed of modern communications ensures that financial panic spreads worldwide in real time, leaving policymakers perpetually behind the curve. Insurance markets would struggle to cope as well. Shipping, energy, infrastructure, and even financial derivatives are heavily insured. But insurers cannot price for a sudden, unprecedented geopolitical conflict. Premiums would spike, coverage would be restricted, and global trade could slow dramatically. Factories and ports unable to secure insurance might halt operations entirely, compounding supply chain disruptions. Prices for everyday goods would skyrocket as shortages ripple through global markets. The economic pain would quickly extend beyond financial elites, affecting ordinary consumers worldwide, from gasoline pumps to grocery store shelves. Stock markets, already battered by volatility, would see unprecedented levels of circuit-breaking events. Exchanges would struggle to maintain orderly trading. Margin calls, automated sell programs, and investor panic would reinforce downward spirals. By now, energy costs would feed into inflationary pressures, interest rate hikes, and unemployment risks. The interconnectedness of modern finance means that no market is truly insulated. Even sectors not directly tied to energy or emerging markets would feel the shock. Because investor sentiment and confidence, rather than fundamentals alone, drive modern market movements. By the end of the first week, it becomes clear: the global financial system has entered uncharted territory. The initial strikes on Venezuela, intended perhaps as a geopolitical maneuver, have triggered a worldwide economic chain reaction. Oil markets are unstable. Emerging markets are collapsing. Hedge funds are liquidating. Cyber risks are rising, and systemic debt crises are brewing. Governments, central banks, multinational institutions can attempt to stabilize certain sectors, but the scale of the shock ensures that containment is nearly impossible. In essence, this is a market event unlike any in modern history: fast, global, and self-reinforcing. And yet, amid the chaos, some investors would find opportunities. Safe haven assets like gold, silver, and U.S. Treasuries would surge. Cryptocurrencies could see both volatility and spikes in demand. Those with foresights or simply luck might navigate the crisis successfully. But for the majority of markets, the damage is already done. Supply chains, energy stability, and financial trust, the core pillars of the global economy, have been shaken. Once shaken at this scale, recovery could take months, years, or longer, depending on how geopolitical tensions evolve. In conclusion, U.S. strikes on Venezuela would not just be a regional military event, they would constitute a global financial earthquake. The combination of energy disruption, leveraged financial systems, emerging market vulnerabilities, and geopolitical tensions ensures that no market is immune. The first 72 hours trigger panic. The first week exposes systemic fragility. The first month could redefine economic stability for years. History has shown that when markets lose confidence, they do not easily recover. A small regional spark can ignite global catastrophe, and Venezuela is that spark in the current geopolitical landscape. You found this analysis eye-opening and want to stay ahead of the next global market crisis? Don't forget to like this video, subscribe to Hidden History Vault, and hit the bell icon for notifications. We bring you the stories behind the headlines, the hidden forces shaping our world. The world is changing fast, and understanding these risks isn't optional. It's essential.